Services, as I indicated, is about 53% of India's GDP, and its weight in the index is 47%. Agriculture is about 21% of India's GDP. Its weight in the index is 5%. And industry has a 26% weight in economic activity, but its weight in the index is 47%. Now, if I was to go back in history and I was to ask everyone in this room, what would have been the weight of services? Today, services is 47%. The weight of services in the index in 1990 was less than 1% and has grown in the index to 47%. So if you'd bought some services stocks in 1990, didn't matter what it was, the total demand and total construction of real estate in the country today is about 534 million square feet. And estimates by Deutsche Bank, I'm using all these nice international names because they're creating these wonderful stories, by Deutsche Bank and Knight Frank is, by 2010, total demand for real estate will be an extra 2,860 million square feet. That's the supply and build out that's going to happen. So an extra 2.2 million, 2,200 million square feet is going to come up, which is about 5 times what we have today. And in certain sectors, we look at retail, which is the malls, from 32 million to 130 million, about 4 times. We look at commercial, from 27 million to 580 million, a huge increase, 20 times plus, 21 times. Now let's see how much money you need for this. We need a lot of money as a country to build roads, to build power plants, etc. If you assume that the price of land at an average across the country is 2,000 rupees per square foot, it costs about 2,000 rupees per square foot to add construction of international quality and decent quality. And you take that 2,326 million square feet. You need 200 billion US dollars to finance that. That's about 25% of India's GDP today. That's more than the money that State Bank of India and all the other Indian banks have been lending out in the economy for the last 3 years, just for real estate. Okay? And to give you some numbers to complete the cycle, that's the amount of money that is required if every real estate developer wants to fulfill his or her dreams. Because foreign money came in, and for every 1 rupee of mutual fund buying since 2003, there's been 7 rupees of foreign buying since 2003. 1:7. And on top of the 7, those who read the papers and those who say, yeah, foreigners love India, FIs love India, they love emerging markets. It was understood that when you went to your terminal and when you did your day trading with your broker, you knew the foreigner was going to buy those top line, front line shares, those mid-cap shares that are hot. So every Indian retail investor told his broker, buy me 100. Because he knew by the afternoon, when London opened, the FI would buy those 100 off him for a higher price. It was a very clear one-way bet until May 2006, when the foreigner did not come to take those 100 shares from your hands. Then everyone panicked and said, my God, futures margin, this margin, cash margin. They began to unwind. That caused the market to go down. The foreigner saw his cost of money going up. He began to dump in India too. And that's why you had that very steep fall and the market had to close.